everyone. This is Meenakshi Davar here, your fund manager for Nippon India Value Fund. Welcome to yet another episode of Straight from Fund Manager. So today I'm going to tell you about what is our outlook on the market and why we believe that value as a theme is at a very interesting juncture for any investor, and how are we placed to take advantage of the current market scenario. So if you look at the current market scenario, it is operating at a lot of push and pulls. So on one side, we have economy and market recovering from the COVID shock. And this is after 2 years that we are seeing normalized quarters. Companies are getting into normalized earning trajectory. But on the other side, we are seeing new issues which are cropping up because of Russia-Ukraine issues. We, after a long period of deflation, we have seen such strong inflation, and globally everybody is talking about rising interest yields. So, and also we are seeing the reversal which got in the economy, the stimulus we saw both on the monetary side and fiscal side. Everything is now rolling back, and we are going to see a normalized stimulus from globe across and also in India. Specifically, if you look at the broader market valuations, where we are and what is the earning expectations of the market, the expectations from the market is of 15-16% earning growth rate, which is a good growth rate for our economy. And from period prior to COVID, when we would be talking about 7-10%, the trajectory of earning growth rate has definitely gone up. But large part of it is already being there in the price. So if you look at valuation, we are at 20% to 20-30% premium to our long-term average. So we have to see it in the context of the earning cycle that we are in. So the question is that why are we saying that value is at an interesting juncture, and why value stocks are better placed in the market than their traditionally so-called growth counterparts. So in an environment when globally yields are rising and we have higher inflation expectation, any company which derives its value from future cash flows, because cost of capital is rising. So any company which has a lot of value placed in 10 years, 15 years later, automatically the value of those cash flows and those companies keep coming down as and when yields keep going up. Whereas so-called value stocks, which derive a lot of its value from near-term cash flows and traditionally are more asset plays, in an inflationary environment, they become far more lucrative and far more valuable. Also, if you look at the earning mix and the delivery of a lot of these value stocks, after a long period, a lot of these stocks which are traditionally bucketed into the value segment, like infrastructure, commodities, financials, energy, etc., they are delivering far better number than the last cycle, or if you look at last 10 years. So they're both confidence on earning delivery, the valuation that they are at, and the outlook is far more constructive and far more superior than the broader market. Now, Nippon India Value Fund is quite well placed to take advantage of the current market scenario. As I have explained in my earlier series also, that there are 4 pillars of value investing that we follow in our fund, and we have been very strongly following it, diligently following it in our fund when we do our fund construction. First thing is that we always prefer to buy companies which already have done investments and there is very strong visibility of cash flows. So we do not buy companies where the company has to change in its outlook, or have to do some certain investments to justify its current price, because that comes with lot of risk. The second thing is that we like to buy good assets at bad times. So market disproportionately values gives a lot of weightage to what is happening in the near term. So whenever near term earning delivery is good, the valuation of those companies get re-rated and they start trading at two standard deviations above their long term averages. And when the near term earning outlook is bleak, they get disproportionately sold off and then they start trading at one or two standard deviation between on their long term averages. So we really like to play those mean reversion trades. We like to buy good assets which are trading at least two standard deviation from their long term averages. Because time and again we have seen in the market that mean reversion and sector rotations keep happening, and if you are early in the cycle to identify these stocks and these sectors, it is really good for investments. The third thing is that we like to play a lot of valuation arbitrages in Indian market. So a lot of sectors and a lot of companies in India do not have a very long history. If you compare what is their earning growth potential, what kind of cash flows these businesses are generating, what is their return profile, and then maybe compare it with the similar kind of company in any other sector. And if we see that the valuation arbitrage is 50-60% versus a company which has a long established history, we like to buy those names. The fifth thing is that what we do not buy in this fund is we will never compromise on quality. So quality of promoter, quality of business, corporate governance, they all are really, really important for us. And we will also not buy companies where we see that there is terminal growth issues. So any business where we think that the business itself doesn't qualify to be a good business with longevity, we will stay away from those names irrespective of the valuations, because we have seen that historically also the hit rate of these companies surviving and then making money from the investors is very, very low. From the time that I interacted with you last to now, the fund has benefited a lot from its exposure into telecom, into infrastructure, metals, the India manufacturing themes that I talked to you about, and real estate and power stocks. We have also benefited a lot from the bottom-up ideas where, as I explained it to you earlier, where we saw big relative valuation arbitrages. There also the fund has done exceedingly well. What has not worked in the fund is a bit of our exposure to auto and consumer discretionary, because inflation has hit them disproportionately and the margin pressures on these companies is very, very high at this point of time. Therefore, market is derated these names over the last 1 year. But we will continue to keep our portfolio very diversified. We have very good mix of large caps, mid caps, and small cap in our portfolio. We continue to like large banks, industrials, real estate, India manufacturing plays, telecom, and lots of bottom-up ideas where we are seeing enough amount of margin of safety. As explained in my commentary, value investing as a theme looks very, very interesting at this point of time, and investors with medium to long-term investment horizon can consider investing in this fund. See you again in the next quarter with more updates. Thank you very much. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.